Hello again, Roy.RealEstate here with Coldwell Banker Legacy in San Angelo. Today I want to talk to you a little bit more about the difference between a pre-approval and a final loan approval. Talked about it a little bit in the past, but just kind of presenting it from a different point of view. So when you go in to get a pre-approval, which is always the first thing you should do really before you start looking at houses, so you kind of know what your budget is. You got an idea from what you can qualify for a loan for, so that you know what price range of houses you need to be looking at. So that's step one. So you go into the lender and you're going to provide them several pieces of information. You're going to provide them your income. You're going to provide them any debts you have, any recurring debts, that type of stuff. And then you're going to give them your social security number and stuff like that so they can pull a credit report. So if you've given them really accurate information, and if they are reasonably diligent when they pull your credit report to look at all the information on it and see the things that might impact your loan, then that pre-approval is a really valuable tool. It should be fairly accurate to what you can qualify for down the road. So what happens between pre-approval and approval is once you've found the property, you've got it under contract, they will go to the next step and they will get verification from you of things that you've reported to them before. So before you told them what you made. So now they're going to need your tax returns from previous years. They're going to need your year-to-date check stubs, things like that, to get really hard numbers on what you're actually making on a regular basis, to see if that is supported by what you told them before. And if it matches that, then again, your pre-approval should be pretty good. But if there's disconnects in there, and there's different times that they can't use, depending on how long you've been on your job. If you've been there 2 or 3 years, there's not much that's an issue. But if it's a new job, for example, if you've had a job less than a year, they generally can't use your overtime pay. So even if you're getting regular overtime, but you've been on the job less than a year, they're generally unable to use your overtime pay in the calculations because they don't know that it's going to be a regular thing. It could have just been real short term. So they don't know. So they need a little bit more history to use things like that. So there's bonuses, different things like that can factor into that as well. So those are things to look at. And then on your debts, that a lot of those will show up on your credit report. Not necessarily all of them, but most of them will, given enough time. So that's one of the things, that if you gave them accurate information when you went in to apply, and then they pull your credit report, look over it, say, yeah, this matches what they gave me, then again, your pre-approval is pretty good. And then there's always a case of what happens between that pre-approval and a final approval. There's the property approval that takes an appraisal, but this is just as far as the buyer approval. So when they go to verifying all these numbers, something could have changed too. If something changed between the time you told them, for example, you bought a new car and therefore have an additional car loan, then that changes those ratios of your debt to your income that they're using to try to figure out how much you're going to qualify for. So that can have a negative effect on you. It's one of the reasons we tell you don't do anything major financial changes between really when you get that pre-approval and the date that you buy the house. Because if you do, it can keep you from qualifying. That means job changes. That means buying anything on an installment loan, whether it's a car or TV, whatever, anything that's that type of a payments type loan. You can go pay cash for something, it doesn't matter. But if you get a new loan for something, then that affects your credit worthiness to the people that they're going to turn around and sell the loan to, so it'll affect you qualifying for the loan. So anyway, those are some of the things. Again, the pre-approval is based on 2 things. A, that you gave them accurate information. And B, that they did the diligence to spend the 10 or 15 minutes to look at your credit report and see if there's any other factors in there besides your score. I mean, your score is a big thing, but it's not the only thing. And so if there's late payments, if there's collections, there's those kind of things in your credit report, and they don't look at it before they do the pre-approval, then you may not meet the final approval later. And that's not a place you want to be. But because at the time you're that far down the road, you've been working on this house for a month or so, as far as working on the buying process, you've done inspections, which you have to pay for. They've done an appraisal, which you have to pay for. There may have been other things that have done that you had to pay for to get to this point, and now all of a sudden you're hearing, whoops, we don't qualify for this house because of something changed, or we didn't get good information to them in the first place, and we spent $1,500 finding out that we don't qualify. And that's a position nobody wants to be in. The sellers are unhappy because they thought the house was going to sell, and then you find out it's not going to be able to sell. You're not happy as a buyer. Nobody's happy in the whole process. So Anyway, the best way to do it is avoid it. Give the loan originator, when you go in to get your pre-approval, give them as much accurate information as you can. Answer their question, then give them the supporting documents. If you can do that earlier in the process is also advantageous. It gets a lot clearer picture of what it is. So the day you close on the loan, that's a very clear picture of your credit history, your ability to qualify. The pre-approval is a very fuzzy picture of your ability to qualify for the loan. But you can make it more clear by giving them more and more accurate information, and help everyone through the process, including yourself. So, have any questions, give me a call. Roy.RealEstate, 325-268-0775. Thank you.